Welcome back to this special segment called MC Pro Stock of the Day with me, Stacey Pereira. In this segment, we bring you some fundamentally strong stock ideas that you could consider in your portfolio. Today, we have for you the largest private bank in the country. Yes, I'm talking about HDFC Bank. The bank has enjoyed a premium valuation until its merger announcement, as well as the consistency in its performance across credit cycles. As of September end, the private bank has seen advances of 23 lakh crore rupees. HDFC Bank now also trades at par with ICICI Bank in terms of its valuation, as the merger has weighed down that stock performance. So why has HDFC Bank's stock underperformed? The bank has underperformed the Nifty in terms of its stock returns following the merger announcement, which happened on 4th of April 2022. The street is now worried about the sustainability of growth on the bigger balance sheet. We also have seen a rise in the regulatory costs as well as the margins decline post the merger, which could be areas of concern. Now, HDFC Bank's EPS or earnings per share in Q2 of FY24 grew by about 10% on a YOY basis when compared to the Q2 of FY23, which clearly reflects the effect of that merger. Now, if you remember, historically, HDFC Bank has delivered earnings growth of about 30% on a YOY basis every quarter for a very long period of time. And now that has moderated to about 20% YOY in the past few years, and that further coming down to just about 10% now. So, what then do we like about the company? It has a strong business growth despite the huge size. Now, HDFC Bank continues to gain market share as well. Its overall advances grew by 4.9% between June to September of 2023, implying an annualized run rate of around 20%, which is quite healthy. HDFC Bank's deposits too have grown by about 21,72,858 crores as of September end, which means a growth of about 1.1 lakh crore in Q2 of FY24. Now, the deposit growth of 5.3% between June to September 23 also could be attributed. If extrapolated to an annualized number, that would reflect to around 20% growth. Now, credit and deposit growth are likely to remain healthy in FY24 as well, aided by the growth across their business segments. HDFC Bank has also opened about 1,479 branches in FY23 and plans to add about 1,500 every year from FY23 to 25. Around 40% of the total branches are less than 10 years old. And as these branches mature, they will start contributing more towards the deposit growth. In fact, the strong deposit growth is pretty paramount as the bank's credit to deposit ratio or CD ratio stands at about 108% as of September end, which is then expected to come down gradually over the next few quarters. The bank's CASA ratio too has declined to 37.6% as of September end, which was anticipated at the back of that shift of CASA deposits into term deposits due to the higher interest rates. Now, HDFC Bank also reported NIMs or net interest margins of about 3.4% in Q2 of FY24, much lower compared to the 4.1% pre-merger. Margins did take a knock due to the excess liquidity carried by the erstwhile HDFC and also the incremental CRR that was imposed by the RBI. NIMs, though, will remain below pre-merger levels in the near term, and in the medium term, the replacement of erstwhile HDFC's market borrowings on maturities with the bank and the deposits will lead to cost benefits in the funding side at least and improve their margins. Let's look at the asset quality, which we could say is the best in class. Now, HDFC Bank saw an uptick in its GNPAs or gross non-performing assets, the ratio, as some loans from the erstwhile HDFC's non-individual or wholesale portfolio were classified as NPAs. However, credit costs has declined as compared to last year, indicating that the bank didn't have to take on much additional provisions. And healthy provision coverage ratio or PCR also, along with the contingent provision, will limit the credit costs as well as aid their future earnings. Now, despite the lower margins as well as other merger related hiccups, profitability was maintained as the bank delivered on its ROA or return on assets of about 2% and ROE of about 16% in Q2 of FY24. The management is pretty confident of delivering a returns on assets or ROA of between 1.9 to 2.1% in FY24. A healthy top line with net interest income growth as well as high provision coverage ratio or PCR will also cushion the future earnings. A look at the valuation picture then, and the stock is trading somewhere at 1.9 times the core book value, which is adjusted for subsidiaries, estimated for FY25, and is quite attractive. The merger has weighed down on the stock's performance overall, but the street seems to be extrapolating the near-term merger hiccups to the future years. And given the bank's track record as well as execution capabilities, HDFC Bank can positively surprise the street on its earnings growth, albeit in the next fiscal, which can lead to a valuation re-rating as well as stock upside. So let's then look if there are any other kind of risk that one needs to watch out for. Well, a slowdown in credit offtake, no recovery in margins as well as higher slippages and lower earnings growth could create some hiccups. Moreover, any adverse macro environment could actually then change the game for HDFC Bank. With that, it's a wrap. Thanks so much for watching.